Right, I'm going to do a follow up from yesterday and also several months ago. We were talking about any El Nino effects, and Juggy uh, asked about that the other day. So here we go. Where should we start? So, El Nino agricultural sea variable work and the Hormuz divergence model. For the first time, these two have collided. A climate shock and a geopolitical shock arriving together, both aimed at the same target, the world's food system. So, as Charlie Munger said, I'll say above, the first rule of a good education is that you can't really know anything if you just remember isolated facts. If the facts don't hang together on a latticework of theory, you don't have them in a usable form. Quote the great Charlie Munger. And as I say, that's not just a decoration. That's not just something to say. Think about it. The framing first. Globalization gave us cheap food by stretching supply chains thin. Efficiency purchased with fragility. Now watch the sequence. Crops face drought and water stress at precisely the moment fertilizer becomes scarce. Logistics networks strain under rising fuel and insurance costs. Farmers, squeezed on inputs and uncertain on freight, are delaying planting decisions, and already stressed supply chains begin to fail. The output of that machine is higher food prices, much higher food prices, and with them hunger, displacement, and unrest across the vulnerable regions. This convergence is today's briefing. El Nino, the numbers. In order of importance, NOAA's advisory is in effect. El Nino is present, not forecast. It's here. 97% odds it persists through to early spring 2027. Better than 80% odds it ranks among the strongest events on record. We're talking the 1982 to 83 and the 2015 to 16 level. Most dynamical models put the El Nino 3.4 anomaly beyond 2 degrees by July-September window. The multiplier is the fourth box. The positive Indian Ocean dipole above 90% probability by September. When El Nino and a positive IOD stack, Australia and Southeast Asia dry out together. 2015 and 2023 both taught us that lesson. The academic anchors, Cashin, Modads, and Rassi in the Journal of International Economics showed El Nino shocks lift global commodity price inflation. Brunner in 2002 found ENSO explains a remarkable share of primary commodity price variation. The weather forecast knowledge, an A variable, the cascade through import costs is not. Add it to things like diesel. The increase in diesel price will be an added increase to food prices. Where the drought bites. Rice is the epicenter. The World Bank flags output at risk of falling 20 to 50% across Southeast Asia, Southern Africa, and parts of East Asia. The market has begun to notice. CBOT, Chicago Board of Trade, rice up 24% in the first half of 2026. Thai benchmark at a 1 year high, up nearly a quarter year on year. Australia, FAO has already cut the wheat forecast below the 5 year average. And note their reasoning: not just rainfall, but elevated input costs, curtailing plantings. That's our fertiliser channel showing up in someone else's crop report. India is the swing factor. A falling monsoon puts exports restrictions on a hair trigger. And Delhi's rice export policy is the single biggest lever over Asian food prices. The offset matter too. US corn holding average yields on 2015 analogue, Brazilian soy actually benefiting. This is divergence, not uniform shortage, which is why relative positioning beats indiscriminate longs. Hormuz, what's happening? The 17th of June ceasefire memorandum of understanding, or as many say misunderstanding, has collapsed as expected, resulting in a near total maritime standstill in the Strait of Hormuz. Following the failure of the truce, which saw the traffic drop to just 25 daily vessels, the US reinstated a naval blockade on the 14th of July, amid continued attacks on shipping and disputes over Iranian-imposed transit fees. The structural point outlasts every headline. Ras Laffan's LNG damage is a 5 year repair job. They tried to restart one of the undamaged trains several weeks ago, and it blew up and destroyed several more. So they will be waiting the 3 to 5 year repair period. Qatar Energy's downstream urea is halted regardless of any further ceasefire, which isn't going to happen. Killen's 2009 taxonomy applies. This is a supply shock with a precautionary demand overlay. It's a persistent kind, not a demand blip. Okay, fertiliser. Well, we'll have a good look at the C variable. The Hormuz disruption removed roughly 1/3 of globally traded fertiliser volumes. Urea, the world's workhorse nitrogen, hit US $725 a tonne in March, up 54% in a single month, a 4 year high, over 80% from February to April. The World Bank projects fertiliser prices will go up another 31% on average to the end of this year, with urea alone up around 60%. And supply keeps tightening with three directions at once. Qatar's urea halted, China restricting restricting exports to protect its own farmers, Morocco's OCP pulling phosphate capacity for maintenance as sulfur and ammonia flows wobble. Remember the lag. Fertiliser not applied in 2026 is yield not harvested in 2027. The market prices the March spike. It has not priced the 2027 harvest. Red Sea, structured pause under tension. The second choke point never healed. Suez container ship traffic was still 26 a week by mid-January against 80 pre-crisis. Egypt is out more than $8 billion. The Cape Detour still adds 10 to 14 days, Asia to Europe. The Houthis paused after the October ceasefire, then resumed once the Iran war began. And on the 5th of July, a cargo ship triggered a distress alert off Hodeidah. The analyst phrase is exactly right. A structured pause under tension. Capability institutionalized along Yemen's coast. Intent contingent on the US-Iran temperature. Insurance and freight premiums have been structurally re-rated. The pre-2023 Red Sea is not coming back, and every fertilizer and grain cargo between Europe, MENA and Asia carries that cost. Now the convergence. This is the machine assembled. 3 pressure sources at the top. Drought, fertilizer scarcity, freight inflation. 1 behavioural image in the middle. The farmer's planting decisions. That's the underappreciated node. A farmer cannot price his urea or his freight rationally plant less or later or not at all. Deferred plantings are invisible until acreage reports land, and by then the following season is already written. Then the bottom band. Food prices ratchet up, and Bellemaire's finding in the AJAE holds. It is the level of food prices, not their volatility, that drives social unrest. The 2007, 2008 and 2010-2011 episodes both ran through this exact circuit. Okay, now we have to face the human ledger. The stakes plainly. Up to 45 million additional people at risk of acute hunger by late 2026 if the conflict persists, which it certainly looks like it's going to, or there will be a very serious event to end it. Up to 45 million additional people. 87 million already facing hunger in East and Southern Africa. Half of low-income countries running food inflation above 5%. And, excuse me, and AMIS's July scenario, crude sustained at US $115, lifts world agricultural prices 4.5% this year, and over 8% by 2027, with the dominant transmission being fertilizer cost, not fuel. The exposure map writes itself. Net food importers who also import fertilizer, MENA, Sub-Saharan Africa, South Asia, get hit twice. As economists, we note the mechanism. As traders, we note that today's quiet C variable is tomorrow's front page A variable. As punters, we note it's a bloody tragedy. And Fry's not happy about it, but we're traders. A variables versus C variables. The contradiction matrix applied. The left column, loud and priced. Oil headlines, the MOU signing that promptly stripped the war premium from metals and crude, even though the majority of people knew it was crap. The universally known El Niño forecast. The grain rallies already on the tape. Right column, quiet and structural. The fertilizer, yield lag into 2027. 5 years Ras Laffan repairs, LNG. Planting deferrals invisible until reports provided. Re-rated freight and insurance as a permanent feature. India's export hair trigger. Our entire edge has always lived in the right-hand column. The left-hand column is where the crowd trades. The right-hand column is where the crowd will be trading in 6 months. We need to look at it. Another very, very important point that I thought of after I wrote this. The Somali pirates, the attacks have increased substantially since this war started. Think about it. A lot of freight is avoiding this area. So it's going around the Cape. The Somali pirates are there waiting, but the mainstream media is not reporting on it. In fact, very few are. It came to my mind because I watched Black Hawk Down the other day, and I thought, well, bugger me. Somali pirates will be taking a nice chunk out of this lot. Anyway, thought I'd add that in. Important, in my opinion. Okay, first half 2026, divergence, not uniform inflation. If we look at the shape of the scoreboard, not the individual bars, rice and wheat carry both shocks, El Niño exposure and fertiliser intensity, and they lead. Rice up 24%, wheat up 16%. With July WASDE confirming the smallest US wheat crop since 1970-71, 55 years ago. Sugar, cocoa and coffee sit outside both shock paths, with Brazilian rainfall a positive, and they're down. That divergence is the fingerprint of a shock-mapped repricing rather than generalised inflation, and it validates the framework. Jubilava's 2018 AJAE paper matters here. ENSO effects on commodity prices are asymmetric and forecastable months in advance. Weather-driven agricultural trends persist. Moskowitz, and Pedersen give us the momentum overlay for the same conclusion from the price side. Okay, trade map. Fundamentals, now we wait. Okay, so as the doctrine always says, doctrine first. Tonight is stage 1 only, fundamentals. Stage 2, the algorithm where no position exists until a relevant diamond appears, and we'll let it sparkle. The candidate's DBA ETF is the cleanest single expression of the whole thesis. Broad agriculture, both shocks in one wrapper, and we have precedent with the October 28 to 30 bull call spread. A debit structure is licensed here under the high conviction exception, the WEAT, the wheat, respect the caution flag, the smallest US crop since 1970, is now an A variable, partially priced. We'll wait for a pullback plus the signal, and premium selling via bull put spread is preferred to chasing strength. The fertiliser equities, Mosaic, Nutrien, CF, are direct C variable plays. Margin expansion while urea holds above 600. New tickers, so prices and the tabs get built before anything else happens. And the energy names already under coverage, VLO, LNG and USO, carry the reload optionality, well, because the MOU has already cracked. Okay, and I mentioned I've updated the algorithm, and I'll make a video about that to explain some improvements. Okay, slide 13, lattice work. Again, runs through Munger's saying we started with about putting things together, create a theory out of it. As I said, slide 13 is all about Charlie Munger's idea of study. Okay, put everything together, make a thesis out of it, and then we can work the tickers, work what we should be trading in. Okay. Close up with, uh, as mentioned, that was the first stage. I'm running all the tickers mentioned through the algorithm, and I'll give more information on that in the next day or so. I've got the final polish and checks. Uh, the references are on the next slide.